Back in the 1600s, a powerful trading enterprise from the Netherlands was sailing across oceans with fleets of ships. They transported spices, silk, porcelain, and precious metals between continents. But financing these long and risky voyages required enormous amounts of money. Instead of relying only on wealthy elites, the company offered regular citizens a chance to contribute funds. In return, investors would receive a portion of the profits from successful expeditions. By pooling money from the public, the company could afford bigger journeys, reduce individual risk, and expand faster than ever before. Shares of the business were bought and sold in busy coffeehouses and port cities. Without realizing it, this model laid the foundation for what we now call the stock market. Since that time, businesses have continued raising capital by offering ownership stakes to investors. Today, the stock market has grown into a global financial system with entire careers, university degrees, and TV networks devoted to analyzing it. But the modern market is far more complex than its early version. So how does it actually work today? Imagine a new coffee brand preparing to expand nationwide. To raise money, the company first approaches large institutional investors, banks, hedge funds, and investment firms. If these early backers believe in the company's future, they invest significant capital and help organize what's called an initial public offering, or IPO. An IPO officially lists the company on a public exchange. From that moment on, everyday investors, individuals like you and me, can buy shares. When someone purchases a stock, they're buying a small ownership stake in that company. The money raised helps the business expand, open new locations, hire staff, develop products, or pay off debt. If the company performs well and investors believe it has strong future potential, more people want to own its shares. As demand increases, the stock price rises. That benefits existing shareholders because the value of their investment grows. On the other hand, if the company struggles, maybe profits fall, leadership changes, or bad press spreads, investors may lose confidence. When more people start selling than buying, demand drops, and when demand falls, the stock price declines. This constant tug-of-war between buyers and sellers determines a company's market value. But stock prices aren't driven by performance alone. Many forces influence the market: rising material costs, new technology, labor expenses, government regulations, interest rates, and global events can all affect investor behavior. Even psychology plays a powerful role. If enough investors believe prices will rise, their buying can push prices higher, sometimes beyond what fundamentals justify. And if fear spreads, widespread selling can drive prices down quickly. Confidence and emotion can fuel massive booms or painful crashes. Because of this unpredictability, many financial professionals encourage long-term investing instead of trying to chase short-term gains. Historically, patient investors who focus on strong businesses and hold through volatility have often fared better than those attempting to time every market move. Today, investing is no longer limited to the wealthy. Thanks to the internet and modern brokerage platforms, nearly anyone can open an account and begin investing with relatively small amounts of money. With education, discipline, and a clear strategy, individuals can participate in the same market once reserved for powerful merchants and financiers centuries ago. The stock market is ultimately a system built on ownership, opportunity, risk, and belief. And getting started begins with a single decision: to become an investor.